let's not beat around the bush. 5 years ago, normal people outside of investing probably had no idea who Nvidia was or what they did. But since AI has become a thing, Nvidia has been the picks and shovels play, making the whole AI boom possible in the first place. It is one of the world's largest companies, and they reported earnings after the market closed today. And the market, by and large, liked it. There was one really big number that should get investors really excited, but there was also one number that investors will need to keep their eye on. So what does this mean moving forward? Well, my name is Brian Stoffel. Let's spend the next couple of minutes trying to figure this out. And at the time of this recording, I do own shares of Nvidia. This was their second quarter of fiscal 2027. They have a funny calendar. Their market cap when it opens tomorrow will probably be around $5.3-ish trillion. On the top line, revenue, this is for one of the largest companies in the world. Revenue more than doubled to $96 billion in just 90 days. They did over $1 billion in sales every day. And that was ahead of analyst estimates and the midpoint of management's guidance. Now, on profitability, earnings per share came in at $2.46, which was more than double as well, and ahead of analyst estimates. Now, management guided for about $60 billion in operating income, and it came in at about $64 billion. So there was a beat there as well. Gross margins expanded to 75%, super important. Operating margins expanded. Net margins expanded. Free cash flow. Now, this is interesting. So free cash flow grew meaningfully from about $13.5 to $21.5 billion. That's great. But look at the difference. Net income came in at $60 billion. Free cash flow came in at about a third of that. That is one of the more alarming numbers that we will dig a little bit deeper on in just a minute. The balance sheet is in great shape, about $100 billion in cash, about $33 billion in debt. We'll talk a little bit more about why that debt might be showing up as well, but let's go through. Revenue up more than double. The cost of that revenue, it was up 87%, but that's slower growth in revenue, so that's good, and that's why gross profit grew faster than revenue did. But really, look at this. Operating expenses grew 55%. Normally, that's a bad thing. In this case, it was only half as fast as revenue did. So your operating income was up 124%. Your net income was up 126%. And oh, by the way, the number of diluted shares outstanding was down by 1%. That's great news. What else happened during the quarter? For that, we're going to head over to fiscal.ai. Now, what I've done here is I've broken down the revenue into three buckets. This green bucket right here is hyperscaler revenue. This is your AWS, your Azures, your Google Cloud, buying Nvidia chips, buying the whole Nvidia stack, and saying, this is the revenue that goes to those customers. It's a huge percentage of revenue. The blue are AI clouds, industrial, and enterprise customers. So you might have a company like, let's say, ServiceNow that buys Nvidia chips, or you might have Anthropic buying Nvidia chips. And then down here, we've got edge computing, which is all the other ways that it used to be used in the past, like automotive and gaming. It's now this teeny tiny one. It used to be the most important, and that's where it is now. The important thing is to look at how these are growing. And what we see here is that this right here is the growth rate for their hyperscalers. The important thing to note here is that it did reaccelerate. Now, part of that reacceleration is that one of the big customers was moved from the blue to the green. So, fudging it a little bit. It's okay that hyperscalers aren't growing triple digits. And look, 93% growth last quarter, meaning that if that one AI customer didn't change over, might have been in the 80s, that's still okay. But what's really impressive is this. If we look at how the AI, clouds, industrial, and enterprise customers grew, what we see here is that it is going through the roof. And that, going from 91% growth to 138% growth, is including losing the biggest customer. We don't know who that is. There's some thoughts out there. It could be OpenAI. It's hard to say. But they lost that, and we see how much. So this is a growth story that goes beyond just hyperscalers. The customers are getting more diverse. Now, some of it deals with circular financing, which we'll talk about in a minute, but that's just worth pointing out. All right. The other thing that I want to point out, I talked about before. So what we've got here first, this is the company's net income over time. So this is what it counts as profits. You'll notice $58, $59 billion, so $120 billion in profits over just the last 2 quarters. But that's accounting profits. This is what the free cash flow is. Now notice that the free cash flow for the last 1, 2, 3, 4, 5 quarters is notably slower than the net income, which means they're not actually collecting $60 billion. They collected $20 billion. Is that alarming? Why is that falling short? Well, the main reason it's falling short is this, especially in the most recent quarter, change in trade receivables, which basically means their accounts receivables grew by $22 billion over the same time last year. That's big growth. Now, why did it do that? And I quote, because of extended terms for large purchases by investment-grade customers. Let me basically say what that means. We are giving our largest and our best customers longer to pay us back because their budgets are stretched. Now, anyone who's been following the AI trade should know about this. AWS, Meta, Microsoft, SpaceX, Tesla, I mean, you name it. They are not only using all of their free cash flow to fund the AI build out, they are taking on debt. They are issuing equity. And so Nvidia is basically saying, hey, we're going to throw you a bone. We're going to give you more time to pay us back for these multi-year agreements. And the main reason, the thing that Nvidia wanted to calm people about, as I said, the main reason we're willing to do that is because you're investment grade. Because Amazon, you've got this other business that's really successful. Meta, you've got this other advertising business that's super successful. Microsoft, you've got this SaaS business that's super successful. So we're comfortable doing that. We think it's in our best long-term interest to do that. And I will give management credit. They called out the elephant in the room. They said, some people will look at the way that we're financing things because they do buy shares in companies that buy their products. And, you know, Anthropic, OpenAI, they're buying Nvidia products with Nvidia money. That is the definition of circular financing. Now, whether or not that's a problem is a bigger question, because management said that the only thing that's holding back Anthropic and OpenAI from growing is not a lack of demand, it's just a lack of compute. And they can't have that compute unless they have the money to build out. And Nvidia happens to have that money, and they said that they have worked out these contracts so that they actually get revenue twice. They get it once when they ship the hardware, but twice once revenue gets beyond a floor for some of these companies that they have agreements with, then they get a percentage of the revenue that comes in after that. Now, that all sounds fine and good. We know that if things go south, that could be a real problem. But that can be true, both and. That can be true, and it can be true that so far there are no signs of that happening. So that is kind of, that was the one warning sign, is that there is this huge difference between free cash flow and net income. On the other hand, there was another thing that the company released that was incredibly bullish. Now, this right here, this is their guidance for the next quarter. They're calling for a midpoint of 89% growth. My guess is that's going to come in even higher because they always come in above their midpoint. So it'll be in probably the low to mid 90% growth, which is way ahead of what analysts were expecting. They're calling for roughly $71 billion in operating income. It'll probably come in higher than that, basically doubling. Analysts just, they forecast earnings per share. But that wasn't even the big thing. The big thing that the company said was that they believe that revenue in fiscal 2028, so we are in the second quarter of fiscal 2027. So what I want to show you is this. Okay, so this is revenue growth by fiscal year. So in fiscal 2024, which is really 2023, grew 126%, then 114%. In 2025, it grew 65%. So far, it's growing very fast. Okay, but what matters here are the projections. So the projection had been for 83% growth this year. I think it's going to be higher than that. I think it's going to be in the mid-90s. Okay. That's not even the important part. The important part is this. This year right here, fiscal 2028, which is basically 2027 calendar year. Analysts have been expecting revenue to grow 44, 45%. Management came out and said, we expect it to grow at least 70%, which means it'll probably be higher than 70%. So instead of 84% growth this year, 44% the next year, we're looking at mid 90% growth this year, and it's only stepping down to 70% growth the next year. That's enormously important. And that is also enormously important because there was another kind of nick in the armor that Nvidia released, which was this. One of the most important things to watch at Nvidia are gross margins, because you have to know that the company has pricing power. If they don't have pricing power, then the worries about this being commoditized, they start to take hold. And so what I want to show you here is here's where the gross margins have been over time. I mean, look at this. Back in 2009, gross margin. So if they sold a chip for $100, they only got to keep $34. The rest of it, the other $66, that's what it cost to manufacture the chip. And it's been going up and up and up over time, which is a sign of a moat. The CUDA ecosystem is one of those signs of a moat, and it's reached 74%. And I mean, we can even look at this on a quarterly basis, and you can just see how incredibly impressive it is. But the gross margins coming down is a legitimate concern. They came in at 75% this quarter. They've been at about 75% for some time. What management said is that the cost for memory is just going through the roof. And there's no way around that. And they have to pay for some of that too. So there's going to be a reset where they believe over the long term it will settle at about 72%. But look, a 72% gross margin, it stinks that it's going down from 75 to 72. But think about gross profit dollars. Going down from 75 to 72, okay, you take a hit there. But the growth rate of the revenue just went from saying 44% a year from now to at least 70% a year from now. That's a huge increase. So those gross profit dollars are still increasing. Management had other things to share. Like they said that their CPU business is expected to more than double in fiscal 2028. They said that before, when they had Hopper, they could get about $18 billion per gigawatt because they have the full stack, okay? With Blackwell, it went to $25 billion per gigawatt, so 18 to 25. And now on Vera Rubin, they're talking $40 billion per gigawatt across CPUs, GPUs, and now LPUs because of their acquisition of Grok. So even though there are some hits taking place, even though there are concerns about circular financing, if something happens to Anthropic or OpenAI, management at least talked a good game. They called out the elephant in the room. They said some people call this circular financing, and they said we see it differently because we're the only ones that have the cash to finance everything that's needed in order to make this work. And we think that given the demand that we know there are on closed frontier models like OpenAI and Anthropic, and on open models like we hear about coming from over in Asia, we believe that that's still worth it. Now, you decide whether or not you believe management of that. Now, as a shareholder myself, what am I going to be watching? Well, first, growth in the data center. The data center, especially when they break it out between the hyperscalers and everyone else. I want to see that growth continually be above 70% for the next couple of quarters. Number two, any type of updates that they've got on their next generation full stack AI platform. I love the details about going from Hopper to Blackwell to Vera Rubin and letting us know what we see there. I appreciate the commentary on gross margins, but you better believe that if it starts going below 70%, that will be a real problem. And fourth, I am going to keep an eye on the divergence between free cash flow and net income because this is one of the richest companies in the world. And right now, it funding everything is just fine. But if things start to slow down, then that does become a problem. Now, what am I going to be doing with Nvidia? What do I think about where it is in terms of, is it one of the top stocks that you should buy right now? Well, it's funny, you should mention that because on September 2nd, I am actually going to be having a very special seminar where I am revealing my number one stock for September. Now, what does this mean? It means given a company's moat, its optionality, its management, its valuation. If I was starting a portfolio today, this would be the number one stock that I went out and got. Not saying you should make it a huge position or a small position, but this is the most appealing to me based on valuation and the company's anti-fragility. I'm going to be revealing that on September 2nd. Now, you can register that absolutely for free with the top link in the show notes below, but don't take my word for it because I started doing this exercise about 3 years ago. And I believe that as a long-term investor, you got to wait at least about 3 years to see whether or not your picks work out. Now, back then, I only did this quarterly. So in July 2023, I called out 5 stocks, and they've more than doubled the S&P 500's return. The S&P 500 did 66%. These 5 stocks did 137%. And I'm even showing you which stocks they are right here. Totally honest, total transparency. You're even seeing PubMatic, it actually lost money. And actually only 2 of those 5 beat the market. But guess what? They beat it by so much that it doesn't matter. And that is how investing works in real life. I did it again in October of 2023. Again, thrashing the market, 141% versus 79. And you can see all of those right there. 3 of them beating the market. Great returns. I did it in December. And look, full transparency. 56% returns across 5 stocks on average is pretty good. That was actually losing to the market. I'm letting you know right there. And these are the stocks that I picked, and that's why. But if you take just these 3, which have had at least 3 years to draw a conclusion about these decisions, you'll notice that they did really well, averaging 111% versus 71%, outperforming the S&P 500 by 40 percentage points over 3 years. So those are the receipts. That's why it might be worth showing up on September 2nd to find out what my number 1 stock for September is. If you'd like a link to that, click the top link in the show notes below. But look, let's look at Nvidia's valuation. Okay, save your seat, but let's go look at Nvidia's valuation. So what I'm going to do here is I'm going to go over to Stock Simplifier, and yeah, we could look at the company's PE ratio, trading at about 26 times trailing earnings. We could look at their price to free cash flow, which is higher, which we already just talked about why it's higher. But I like doing a reverse DCF, and there's a couple different things we have to do here. All right, first of all, I do believe Nvidia has a moat. I know it is historically a cyclical company, and I think that there will always be aspects of cyclicality that are in there for investors who want to stay invested in this for more than 5 or 10 years. So I'm not going to give them a huge terminal growth rate, but I will give them 2.5%. And maybe that's being super conservative, but I'm showing you my work here. I'll give them a 10% discount rate, which means here's what I think the company can do to earn a market matching, to earn the assumptions to have a market matching return. What about its optimized free cash flow margin? Now look, its free cash flow margins have been as high as 44, 47, 45%. I'm going to dial that down, both to be conservative and because I believe that, look, there's whenever you can have gross margins like Nvidia does, there's going to be incentive to create alternatives. So I'm going to pull this optimized free cash flow margin down to 35%. I believe that's being more conservative. Now, what does this mean? It means that if Nvidia can hit a 35% free cash flow margin as kind of like an optimized free cash flow margin, then it needs to grow its revenue by about 20% per year over the next 10 years. That's a high bar. But here's the thing. We should split this growth out because we know that growth is, at least we know the next couple of years it's going to be pretty heavy. Again, we can go back to what analysts are expecting and just pull it up right here. And they expect right now that growth will look like 84%, 44, 25. We already know it's going to be higher. I think it'll probably be more like 95, followed by 70 or 75, followed by maybe 40%. So I think the CAGR on that is probably somewhere between 65 and 70% growth per year over the next 3 years. So if we pull this up and we say, look, over the next couple of years, I believe that Nvidia could grow 65%. Now, let's just look at this for a second. Let's just look at this for a second, because this is the telling sign about what you're getting with Nvidia. Now, you might disagree with the terminal growth rate of 2.5%. You might say a cyclical company needs to be lower. That's fine. I'm showing my work. You might say a 35% free cash flow margin is too high. That's fine. I'm showing you my work. But if they can get 65% growth per year over the next 3 years, which I believe they could get given what they're saying, then in years 4 through 10, their revenue only needs to grow 0.5% per year. Their revenue only needs to grow 0.5% per year. And if they do that, you're still going to get a market matching result. I mean, we can pull this free cash flow margin down to 30% and they only need to grow 4% per year. And so you look at it that way, and Nvidia actually seems like a really great deal. Well, we do know we need to see that those extended terms that they're offering their investment grade customers work out. OpenAI and Anthropic need to flourish alongside the open models. They need to be able to hold those gross margins. But if they can do those things and hit the growth targets that they've talked about right here, it's an incredible steal at today's prices. Is it number one? You'll have to wait and see. But that's my thoughts on Nvidia's quarters. I'm curious what you think. Let me know in the show notes below. And until next time, Brian, out.